Ever feel like the market moves just to mess with you? Like every time you're in a trade, price instantly goes the other way? That's because you're likely trading without understanding the bigger picture, levels, cycles, and most importantly, your bias. In this video, I'm going to break down the core concepts that smart money use to trap retail traders and how you can finally start seeing the market the way the pros do. Let's get into it. So let's start with the levels. Levels form when price breaks away from a specific area, often moving towards zones with high liquidity or shifting away from a moving average. In an upward move, rise level, price tends to pull back towards moving averages. This retracement often tricks retail traders into thinking the move is over, so they enter short. What they don't realize is that they're adding liquidity for the market makers, who then push price higher again. That creates what most retail traders mistakenly identify as support and resistance. The same logic applies to drop levels, just in reverse. Price pulls back and lures in long trades, giving market makers the fuel they need to drop price again. Now let's talk cycles. A typical cycle includes 3 stages of rise, ending in a peak formation that usually looks like an M formation. Then it transitions into 3 stages of decline, which finishes with a W formation at the bottom. These patterns repeat, but not always in the same way. There's always variation. Within these movements, you'll find accumulation zones, areas where market makers quietly build positions and gather liquidity before making the next big move. The structure of each cycle is a bit like a snowflake. No two are exactly alike. How the cycle plays out depends largely on how much liquidity the market maker has managed to trap. The key is learning to spot where you are in the cycle. That's what helps you shape your trading bias. If you're in a rise level, market phase, your bias should lean towards taking longs. If you're in a drop level, mark down phase, your bias should favor shorts. Mastering this gives you the framework to stop reacting emotionally and start trading with structure. The very first thing you should do when opening any chart, especially on the 1 hour time frame, is figure out where price is within the overall cycle. This gives you context. Keep in mind, markets are fractal, meaning there are patterns inside of patterns and cycles within inside of cycles. The larger the pattern you're identifying, the more significant the move you're likely to see play out. Now, how do you confirm that a rise level is forming? You want to see price break above the high of the previous level. Until that happens, the move isn't confirmed. You're still in potential accumulation or just range-bound chop. So here's an example. From the start of rise level 2, when price crosses above the peak of rise level 1, the level is confirmed as the level 2. Now, a rise level is invalidated if the retrace to the start of the next level goes lower than the start of the previous level. Now, here's a list of questions that you guys need to be asking yourself every single day when determining the cycle that we're in. Practice makes perfect. You guys need to train your eyes to look for levels, cycles, and patterns when you open a chart. Mark off peak formations and the rise, drop levels so you can see exactly where price is in the cycle. So to wrap this up, once you've understood where price is in the cycle, identified your key levels and defined your bias, you stop trading blindly and start thinking like smart money. If this gave you clarity, hit the like button, comment your biggest takeaway below, and subscribe because we're just getting started. In my next video, I'll break down how to actually enter and exit trades based on these cycles with real chart examples and exact setups. And if you want a free checklist that walks you through the cycle phases step by step, check the link in the description. Remember, the market moves in cycles. Your edge is learning how to follow the flow. Peace out, guys.